My name is Sarvesh Suri. I'm Regional Industry Director for Infrastructure and Natural Resources for the IFC, based out of Johannesburg, for the whole of Africa. As you know, Africa, the countries in Africa today, are facing challenges because of the triple crisis that's facing Africa today. Starting with the COVID crisis a few years back that have expanded the fiscal space of the countries. Following that, the economics impact of the Ukraine war. Following that, the climate crisis as well. The impacts of these three crises together have caused a significant dip in infrastructure financing in the private sector over the last year or so. There was a 17% reduction. Now, having said that, Africa also presents immense opportunities for investments in the infrastructure space for private sector operators. So we have a distinguished panel of guests comprising development financial institutions, equity investors, private sector operators, and representatives from the government who will discuss the current economic situation as well as how it's impacting the infrastructure financing on the continent going forward. But first, to begin our session, let me invite Mr. Aurélien Moly, who is an expert, Vice President and Senior Credit Officer for Moody's, to come and share a presentation in terms of what is impacting the continent today. Aurélien?
Good evening. I think this session is extremely important for the continent. I will go through the presentation. It's only 8 minutes, so it's going to be fast. But there are a few points that I want to insist on. So let's start with the presentation. Okay, back. Okay, so this first slide is to set the scene. Again, what you can see is that many countries have a gap of funding for infrastructure as percentage of GDP. You have seen many types of this presentation. Sometimes it says $90 billion is missing for infrastructure investment, or 150 billion, or whatever. The good news is the number doesn't matter, because a good project finances itself. This is very important. The continent, when they opened the telecom sector, for example, funding flew from everywhere, and telecom, infrastructure flourished throughout the continent, because the regulation, the way the investment was structured, was really powerful to attract investment. And even the issue with this graph is that there are two main risks that it highlights. The first risk is the climate and the physical risk because of the climate change. And the number that we see is probably much higher, because unfortunately the region is probably more subject to this risk in the future, and therefore there will be an extra cost to this infrastructure that will mitigate the negative impact. And the second element that is important beyond this graph is of course the demographic growth. Infrastructure are needed on the continent. It's extremely important. There is a need of not only infrastructure to grow the economy, to grow the trade, the logistics, the energy. People talk about industrialization without energy is not going to happen. And same for trade, without ports and railways and highways. And therefore, this is the exposure of the continent to the social risk. We all know some capital city where there are ghettos and they are growing young unemployed people. It's really, really high on the agenda. So once the scene is set, it's important to understand what we are talking about when we talk about the risk of investing in infrastructure. Moody's has done long studies. These charts are from a study that look at the reasons for default in infrastructure bank loans throughout the globe. Between 1983 and today. So it's around 40 years of observation. And there is a big difference between OECD countries and developing and frontier market economy. The blue on the right side that you see is country risk. It's the leading reason for default, 35% for developing countries and emerging market countries. The element of the sovereign and its externalities on some project, and I will explain that in the next slide, is very important. Why in OECD countries is only 6%. So the sovereign risk or the country risk is less an issue. And in yellow, what you can see is the market risk. And market risk, it's easier to mitigate. There are tools to mitigate. It's something that can be managed. The other risks are inherent to the infrastructure construction, performance, and so on and so forth. But it's important to understand, because people say why there is not more investment in some of the frontier market, but you need to look at what caused the default in this project. So the sovereign crisis, this is the fourth slide, we're almost there. Is really special because there are multiple channels that can affect a project, and these channels are really reinforcing one another in some cases, and it creates a vicious circle. So on the economic front, you could have a recession, civil unrest, strikes, inflation that could triple the cost of your project. So a country that does not have a credible central bank, that does not have a credible history of stable inflation, it's a risk for an infrastructure or project developer, because its costs might skyrocket because inflation becomes out of control. So that's an example. Financial condition, the currency depreciation. Of course, if there is not enough reserves and there is a shock and there is pressure on the currency, the investor that comes from abroad finds itself in a very difficult situation, especially if there is no improvement in sight on the reasons for the external pressure on the current account. Interest rate also, the bank runs and so on. But the biggest, I think, issue that is difficult to mitigate on the country risk level is really the government policy. Policy uncertainty. One government does something, the next one does the opposite. You have a regulation and then it changes. A regulation could say that the service should be cost reflective, and the authority that fixed the price, is not really putting price that are cost reflective of the production of the service. The trust in public finances. If the debt is skyrocketing, it's probably more tax in the future, and some decision that can impact a project. The risk of moratorium risk. One day a country has difficulty, put a moratorium, the project default because the project manager cannot send the money abroad because the transfer payment is forbidden or caught in the moratorium. So the regulation volatility, I think, is one of the biggest hindrance for infrastructure financing on the continent. And so it has to be looked at hard and cold, because other regions have been able to attract investment in water, in electricity, in a big way, and other sectors that are needed, like ports and so on. Of course, I speak generally. You have good examples also of infrastructure that have been developed in Africa. But I'm talking about the gap here. So the almost last slide, the good news is that we talk about innovation. There are credit enhancement tools that are available that have been developed over the years to mitigate some of the risks. You have the tools that improve the recovery and reduce the default. For example, we can think about insurance guarantees provided by other agents. You have also tools to lower the cost of borrowing. So it's all the institutions that do loan beneficiation to lower interest rate. But, everything that could support sustainability also, it's very important. Diversification of funding, you have a very good example in this country, in this city, the Henri Conan Bédier Bridge that was financed, the senior tranche and mezzanine, with at the beginning the government only pledging to match a certain level of revenue, and after a few years, it broke even with more than 80 passages with cars on the bridge, and it will be financed like that very well. So these credit enhancement tools are very important, and it's the beginning. And I finally move to the last slide. It's where the development finance and especially the MDBs, they play a very important role because they are leading the way in trying to optimize their balance sheet, because it's their role to invest where maybe the market does not invest, and try to leverage their presence. So they use innovation, securitization, they use also credit enhancement tool. You have capital support, you have risk transfer, political risk insurance, and so on. So all these elements are very important. But I come back to the reasons for default in infrastructure, in emerging market and frontier economy. It is the country risk. And it's difficult to, with the example I've given, to control all this risk, but there is a need to find a solution. So I'll stop there. Thanks.
Thank you, Thank you. Well, let me invite my esteemed panel members to join the stage. Mr. Berthe Dauda, Director of Infrastructure and Digital Economy from BOAD. Mr. Olivier Picard, CEO of Ellipse Project. Mr. Christopher Chidiudumi, Managing Director and Head of Africa for the British International Investments, BII. And Mr. Fedel Can, MD, Head of Capital Markets and Structured Finance Group for Sub-Saharan Africa, Societe Generale. Please. So, as you probably know, IFC, the part of the World Bank Group, is the largest development financial institutions that operates in emerging markets for private sector development. We've been investing as well as supporting infrastructure development in Africa for 65 plus years. And today, we make investments and mobilize financing of up to $2.5 billion on an annual basis. Over the last 10 years, IFC has supported and developed more than 170 projects in Sub-Saharan Africa across various infrastructure sectors, starting from the power sector to transportation, digital economy, water and sanitation, and subnational finance. So all these elements, Aurélien, that you mentioned, IFC has been involved in some shape or form, and we'll have a chance to talk about it during the course of this discussion. But let me invite my panel members to first make their opening statement, talk about the issues, but also introduce themselves and the companies that they represent. Would you like to start, Fidel?
Well, you have the client.
Okay, good evening. I am the CEO and the owner of Ellipse project. Ellipse projects provides smart buildings and particularly hospitals in Africa and particularly in West Africa. The specificity of Ellipse project is to provide turnkey hospitals, and our development is very fast. We have our growth was 70% last year, and we expect to do probably the same performance, a little bit more maybe this year. We have based our development on financial standpoint on export finance at the beginning, which was very strong for us, based on France, based on UK and Belgium and so on, and it worked very well. Due to the sovereign guarantee limits in Africa, we are now more and more dedicated to PPPs. So we have signed one big 380 million euros PPPs 3 years ago in Senegal for the modernization of the judiciary infrastructures. And the third pillar now is going to be a private hospital and building and operate private hospitals in some countries. And this is based on project finance, probably on 70% of debt and 30% of equity. So this means that if we want to survive and if we want to continue this growth, we absolutely need to, from the export finance, to diversify our financing through PPPs and through project finance and real investments.
Okay, thank you. Please, I will make my speech in French. Je suis donc.
So I'm the representative of BOOED, and it is one of the 3 specialized institutions of WAEMU in charge of funding projects for the countries, but more focusing more on the private sector. So the infrastructure are up to 7 billion per year. We do invest up to 7 billion a year for infrastructure maintenance. Until to date, these countries are funding 2/3 of this funding. So how can we have the private sector on board to reverse this trend? So if we want to reduce the debts of these states, we need to act upon 4 levers. First, the government needs to have a clear vision on the involvement of the private sector, because each country today has established a benchmark framework for investment, and Côte d'Ivoire, for instance, has clearly said that the private sector has to cater for 75% in terms of financing the National Development Plan. So this is a clear vision. We need 75% investment of the private sector, and the government of Côte d'Ivoire is making provision for that to happen. So we need to have this clear vision. That is the first point. The second lever is the implementation, the setting up of a conducive environment that will be very good for the private sector as well as the public sector. And here, let me remind you that the Council of Ministers of WAEMU adopted during last September in an institutional framework on a particular regulation and on directive, on a guideline for investment in WAEMU on regional projects, and we need swiftly to implement this regulation within these different countries. It has to be enshrined into the laws of these countries so that the private sector can kickstart their activities. So within this regulatory framework, we need to focus on public markets and PPPs. This is very important. We need to be able to digitalize public market in order to assure the private sector. So if it is digitalized, then the different stakeholders will be reassured about the transparency of all the tenders. So another very important point to consider is the implementation or the setting up of some guarantees for the private sectors. So we need to set up several guarantee products that will allow the private sector to invest. We have a various range of products, but the BOAD thinks that the insurers have to be involved. So today we are working at ensuring a level of coverage of our portfolio to increase the credit which are generated in order to release additional equity to carry out more business. So these are the points I wanted to mention that will ease the private investment.
My name is Chris Chujutomi, Managing Director and Head of Africa for British International Investments. Most of you probably would have known us by our old name, which is CDC Group, basically the UK Development Finance Institution. I guess with respect to infrastructure, infrastructure is a key vertical for us at BII. Asset under management is just over $10 billion, of which 35% of that is invested in infrastructure. On an annual basis, we invest about $1.5 to $2 billion across our markets, of which Africa is about 60% of it. So for us, it's infrastructure remains a key asset class for us to continue to invest in. We're an impact investor. We invest alongside the private sector, but we also invest for commercial sustainability. So we don't invest or we don't give capital directly to sovereigns. What we do is we build up investment theses alongside the private sector, because that's where we think the economic growth is for countries within our market. In terms of, I guess, the opening statement about the challenges with infrastructure and the current economic climate, absolutely, we are seeing that. We've seen a slowdown in investments in the infrastructure space, but notwithstanding, because of the massive gap, we talk about $100 billion per year across Africa needed in infrastructure. We still do see investment opportunities. Because we invest across the 54 countries in the continent, we do see the peaks and troughs. You know, there are some parts of the continent today where infrastructure investing is slow, not stopping slow, but we also have other parts of the continent where we continue to see opportunities within the infrastructure space. So I guess you could say that's the privilege of being a Pan-African investor. We've been investing across the continent for the last 75 years, so we do have, I guess, both scars, but also a lot of experience in terms of how you invest in infrastructure and how you approach the asset class. The energy sector is our biggest subsector in infrastructure. In Côte d'Ivoire, we, through one of our majority investment, a company called Globalec, we provide about 35% of Côte d'Ivoire's power. And more broadly across the continent, I'll say probably every other project that is financed, at least with private capital, BII's capital is within it, either through equity, through debt, or through intermediate equity and debt, which is also another tool we use. So very, very pleased to be part of this panel, and obviously we'll look to share some practical views on what we're seeing in the market and how we think we can continue to invest in this asset class. Thank you.
Thank you.
My name is Fadel Khan. I'm heading structured finance and capital market for SocGen for Sub-Saharan Africa, which is a region that goes from Mauritania all the way to Madagascar. Thank you all for coming to this panel. Thank you for the Jeune Afrique and the CEO Forum for inviting us. We hope that at the end of this panel, we'll be able to learn some things and get a push to do more for Africa. At SocGen, what we have been trying to do is that bridge the information gap that you can find in Africa between the quality of the projects, the list of projects that are available, and what an international investor will be looking at when it's investing into Africa. Because we understand that here, the size of the project is not the issue. The quality of the projects are not the issue. The impact and the importance of the projects are not the issue. The issue is that access to information between an investor that is based into developed country that are particularly seeing boxes being checked for specific projects, whether it's power, whether it's roads, and does not see those items being checked when it comes to Africa because of the specificity of the continent. And being able to bridge that gap is our essence at SocGen. That's why part of our pillar within Grow with Africa is to finance infrastructure. That being said, when I was looking at the Moody's presentation, one of the items that I believe is missing and that we would like to see more is that for people to ask themselves the question is that when is the last time they remember a project that was financed and that has failed in Africa? Because that is the paradox of the continent, is that it has the lowest default rate for infrastructure projects in any continent that you can find, the lowest default rate. But it has the highest criteria for investment than any continent that you can find across the world. So when you see that paradox, the goal is that how do you bridge the gap between investors asking sometimes too much in terms of securities that makes the project non-financeable and requirement for the projects to get on the ground and have international investment money. So, and I believe that when we do our presentation and what we are selling, having an understanding of all the projects financed in Africa over the last 10 years, what is the percentage of those that has led to a pure default into the continent?
That's an interesting question to raise, and we'll have a chance to talk about it. But Olivier, maybe to start with you from the private sector's perspective, what do you see as the key impediments for investments when you look at investments in the infrastructure space in Africa? If you could just kickstart the discussion with that.
I look at the opportunity first. I believe that the opportunities for example, in the health sector are infinite. And I believe that, of course, risk exists, but I just want to take one or two elements of the presentation. If you take the private hospitals, what I have seen here is not really the country risk. It's much more, first of all, the market risk is less than in the OECD countries. Second, we provide turnkey hospitals, so there is no construction risk for us. So at that time, the risk to me is dropped by something like 50%. But the opportunity is there. So the most important is what is going to be the business plan, what is the local regulation, because local regulation is important even in the private investment, for the private investment, not only the PPPs. In Africa, you need to know people, this is true, but you need to know the regulation, you need to know the process, the procedures. If you do that, opportunities are everywhere. So I look at the opportunities, first of all.
Well, thank you for that. And I think it goes back to the same point that you were making about the fact that there aren't that many projects that have failed in the PPP space in Africa. So, so maybe going to Bertha, could you touch, and you talked about it earlier, when you as a development financial institution talk to the government about inviting private sector to invest into PPP space in the infrastructure sectors, what kind of advice do you provide to them? What are the top few things that you suggest the governments tackle? There have been questions that have been raised by political risk, around political risk in the presentation, and then you talked about the regulatory aspects, but maybe any comments from your side?
Oui. Ce que je...
Yeah, so what I can add to this, you know, so we have opportunities. We have major opportunities here in Africa, in the YMO space, which are translated into regional programs that are implemented at the regional level. So we also have we have the COCO plan that aims at developing corridors between different states. We have 4 corridors. So one between Lomé and Ouagadougou, one between Tema and Ouagadougou, another one between Tema and Lagos. So we have several opportunities over there. And as the previous speaker said, we need to know the mechanism in Africa, we need to know the procedures in Africa, we need to know the regulatory framework to tap on these opportunities.
Sorry to add something. Part of the failure in the PPPs, not in the private investment, are due to, are under the responsibility of the investors. The way you negotiate, there is much more flexibility to negotiate a PPP in Africa than in Europe or in the United States. The way you negotiate the PPP can make a project very vulnerable or very profitable. So it's really in your hands. If you know the procedures, if you know the regulation, as you said, you have the profitability is much higher than anywhere else. The growth potential is much higher than anywhere else. You need simply to be smart, to understand the African culture or the culture of the country, and to know the regulation. This is very important. And by the way, you can be re-insured by insurance. There are insurance products for PPPs, and you can be covered by insurances.
No, definitely, I think, but there's one key aspect that we also need to all work on is to make sure that the basic regulations in countries are conducive for pre-CVs to take place. But Chris, maybe you want to comment on the, it's not that financing is a constraint. The fact that right now we all touched upon that it has been challenging for infrastructure projects to take on. The key issue is to have project preparation and the regulatory aspects around the countries to have profitable or to have financeable projects in the first place. So can you touch upon that? How do we address that issue, which is one of the key constraints?
Thank you. So if I reflect on the good projects I've seen and the not so good projects I've seen, I think one common element for me is around project preparation and project development. So when you look at the life cycle of a transaction, I think not a lot of emphasis is put on the time and the resources required to actually get projects to a position where it is investable, both from the sponsor's perspective, but also from the government in the case of, say, a PPP. And there's an element in the PPP called partnership. So really, are some of these opportunities that we see, because we know there's a vast amount of opportunities in the continent, is there enough time and resources being spent to get these projects prepared right? And what does prepared right mean? It means allocating the capital, because there's project development required, understanding that, allocating the time, doing the relevant studies, having the right point of contact from a counterparty perspective, who have the capacity and the knowledge to understand what it takes to develop projects. Because I think there's too many reference to, there's an opportunity, you can invest in it. Actually, there's opportunity, but you need to structure the opportunity in a way that investors like ourselves on an equity side or even on the debt side can then invest into it. So that's probably the biggest lesson I continue to see when I look at opportunities that we look at in the continent. Sponsors, there's lots of good developers and sponsors, but a lot of them are actually not willing to put the capital required, or probably don't have access to the right type of development capital. So that's one. I think on the government side, sometimes driven by the fact that across the continent, you typically have a 4-year election cycle. Sometimes the infrastructure projects that you see come to market are driven by political requirements, rather than the fact that these projects need long gestation period. So it's really thinking through the relevant policies or project development units in government that actually outlive different election cycles. Because there's a transaction I'm working on at the minute. It's taken us so far 7 years to develop the project. That's costing capital. That's costing resource. It's a project between 3 countries in the continent. But there's a realization that it does require that amount of time because of all the various variables, from land acquisition, policy, implementation studies, to understand that when the project comes live, that it is affordable. Because again, I hear your point around there is lots of profit to be made, but I think profit is a function of cost and the price people will pay. So I think sometimes there's also a reality from a sponsor perspective that you have to think about the affordability to the end user. So I see a lot of projects that actually they've been designed well, but no consideration has gone into how affordable is it. So it looks good on paper, profitable, but actually as an end user, say a toll road, for example, or use of water, you're not able. So no one's taken the time to understand, is the tariff being set at the right level to make the project sustainable? So for me, if there's one continual lesson I see in infrastructure, is around not enough emphasis on project preparation and project development. I think if there's enough emphasis on that, the successful projects I've seen, people have spent time to develop it. Counterparties understand the associated risk. The risk allocation is done in a way that the private sector understand what risk they're taking on, the public sector understand what risk they're taking on, and there's continual message around, okay, it does cost money, but there's ways where some of these deals can be structured where the development cost is recovered back. So actually, it's not sunk cost. So I think that's one continual thing I see. Now, if I take it away from the government side, because it's not also all about government, a lot of the infrastructure projects I'm seeing that are being consummated and are successful today are actually B2B, where the private sector, especially in the power space, we're seeing a lot of commercial industrial power being done now, or industrial offtake. It's because B2B understand the risk allocation, they understand the importance of time, and they all understand what work needs to be done to get the project bankable. And then the last thing I would say, might be controversial for some of the DFIs in the room, I think there's also opportunity for DFIs to work better together in terms of standardizing documents, financing documents, in terms of making it very clear upfront, the requirements, so that, again, both the sponsor as well as the counterparty government are aware of what risks financiers are also willing to take or not take, so that that can also be structured and designed into it. So I think if some of these messages are taken on board, we should be able to see a lot of these opportunities become bankable projects that investors can go into.
Yeah, no, that's an excellent point that you mentioned. I think there's one link I would also make is that a few years back, the World Bank Group had done an analysis on PPP projects, and exactly what you mentioned is that the average life of a project from start to finish was about 7 years. Now, for the first few projects in a country, 7 years may be okay, but then the countries then need to build on the success of those projects and replicate so that the next PPPs can be done within the next 2 years or so, or faster. So from IFC, one of the areas that we work on is what we call PPP advisory. So we have some programs called Scaling Solar, where we have, as you said, standardized set of documents that we take to the governments and replicate it on a country-by-country basis to streamline the PPP process from start to finish. These documents, the concession documents, we know are bankable. The financial institutions are able to support them. And with that, we try and streamline the process from start to finish so the projects can be implemented from start to finish within 18 months time frame or something. So definitely on some of the project structuring issues that you mentioned, we need to work on, but also replicate and scale them up at a much more significant level. But Fidel, coming back to you, looking at it from the private sector side, you talked about the fact that you've had a good track record of investments or lending in the PPP space in Africa, in infrastructure space in Africa. But what would it take to bring much more private sector capital to bear for supporting projects in Africa going forward?
I believe that what we have been doing at SocGen first is being close to the continent, meaning being inside the continent as an investment bank and as a private investor. Because we realize that for us to be able to access information, to lead a project end-to-end, that it's much more efficient in terms of time management, project management, and taking it from structuring to the market when you are inside the continent. So we are a team of structurers that are based across the continent and across the countries where we have operations that structured projects. And so understand what the international investor will be looking at and structure the project accordingly so that when it comes to market, it's already ready to be invested on. That's the first thing that we have been doing. We have been attracting liquidity because the issue here, once you have a good project, is not the risk anymore, it's where you can find the right liquidity product and the right investors that have liquidity to invest into Africa. And which tools are you offering them for them to invest into Africa? So we have been developing infrastructure funds, credit funds, so that we attract international pension funds, insurance, DFIs and global investors to come and invest into the country and make sure that those projects, when you take them from end to end, you are able to make sure that the investor is repaid, that the project deliver on the impacts that it promised, and that everybody benefits from that project from end to end. And that's actually is key for us. On the latest part is that we understand that most of the beautiful and sexy projects in Africa take 7, 10 years, probably sometimes 20 years to develop. But you have a lot of projects that are ready to be invested upon in the continent today. We probably deployed close to $1 billion of investment into Africa, and we have probably on the same amount of repayment on the projects that we have already financed in Africa. So our issues at SocGen is not mostly where can we find a good project or is the project going to repay us? Our issue is to be able to redeploy the repayment from those projects on other areas as well. And our goal and what we are trying to do today with our knowledge, being present on the continent for over 50 years, investing into infrastructure, and having the investment and the platform to structure those projects is to go out there and meet those investors that have deep pockets and tell them about the story of Africa. Tell them about what Societe Generale is seeing in Africa, why we are here, what are we doing, and what we are seeing as a track record. Because we believe that as an international banks being present into the continent, our voice matters. They understand that the standards are the same than what they are looking for. So when we tell them that this is safe, we are more likely to be heard than other financiers.
I think infrastructure is a broad topic and there's too much to discuss, but I am cognizant that we are getting towards the end of the panel discussion and we need to leave some time for audience to ask questions as well. So I'm going to request each one of you to think of the infrastructure challenge that faces the continent today. If you look at the amount of investments that need to be made in infrastructure provision, the climate mitigation, as well as adaptation, they're expected to be trillions of dollars of investments that are needed from now until, let's say, 2030 to achieve the sustainable development goals. The level of investments that are taking place today is much lower. So if I could request each one of you to think through what, according to you, would be the most critical enablers for us to ramp up infrastructure investments in a much bigger way in Africa. To close out on that, what is it that one or two or three things that we all need to try and tackle, which will give us the maximum bang for the buck, would be helpful. And whoever wants to go first from the panel side.
Maybe I'll go first, because I was actually going to make a comment which I think will be linked to this. So I think one of the most important things for me is we have a lot of capital. SocGen have mentioned they have a lot of capital, but all our capital isn't going to solve the gap. I think one thing we've not talked about on this panel is the paramount importance for local capital to come into infrastructure. Because I think there's a lot of pension fund capital in the continent, there's insurance capital now growing in the continent of Africa, and I think until we see that coming into projects in Africa, we're not going to be able to move the needle. We're not going to also be able to convince a lot of international financiers to come. Because if yourselves as capital in the continent are not investing in the asset class, it's always going to remain difficult. So I think that's one. The whole mobilization thesis, how can we move the needle on mobilization in terms of maybe finding a way to work with government to drive policy to instigate pension funds particularly to invest in the asset class? Because I think that's going to be a game changer. It's been a game changer globally. It needs to be a game changer in Africa. I think that's one. I think the other one, I think, remains capacity building. Infrastructure is a very complex asset class. And it's one that it requires tenacity, patience, and long-term thinking. It's also one that, you have steady cash flow. The returns are probably not the same level as a pure play private equity. And I think the quicker people realize that, the more you have the right type of investors playing in infrastructure. Because I think today, one of the reasons we have lost a lot of infrastructure investors in Africa is because there's an expectation that you're getting big double-digit return in this asset class. I just think those days are gone. So I think you need long-term, patient capital that really understands that this is about steady cash flow over long term. I think that's also another game changer. So I think those two, the theme around mobilization, but also the realization around the return expectation for this asset class, I think I'll probably just leave with the audience and the panelists.
Thank you, Christopher.
Yes, I believe that one of the main issues is the lack of capital in Africa, and but on the other end, I remember when I was in the telecommunication business a long time ago. I remember that the investors were there. The Generally, it was joint venture, 49, 51%, owned by local partners. And there was, at that time, the situation, the economical and financial situation of Africa was much, much worse than it is today. So it means that when there is a real market, when the regulation is relatively clear, when the Western operators can come, and they came at that time, and there is no problem of cash, no problem of capital, but the market has to be obviously profitable, which is not the case today in all infrastructure segments.
So,
But,
so the regulatory regime needs to be transparent and reliable and acceptable.
it has to be stable, it has to be simple, and it has to be transparent. But transparency is not enough. It has also to be simple for new investors.
Conducive.
It was very simple during the 90s with the telecommunication sectors.
Fadel, anything from your side to add? Or?
I think from my perspective, from what we have seen, human capital is key. Human capital when it comes to being able to understand what a project is, being able to understand how to attract investors into the project, being able to, on a relationship side, explain why our project is attractive, and finally being able to manage a project once the project is implemented. I think that is, once we arrive to prove that we can manage those projects easily, I think attracting investment become much easier. The second part is that I totally agree on the financial sector and the local financial sector being able to play a major role. But for it to be able to play a major role, there is a paradox of a double penalty when a local investor take local currency money and invest into a local project because he's paying the cost of capital twice because of regulatory issues. And being able to push our governments, our central banks, to be rated or be recognized by international central bank on the IBRD level allows for any paper that they have issued to be capital alleviated and allowed to attract capital investment into local project and local capital investment. So I think if we are able to bridge those two, with the international investment commitment, the DFI commitment will be largely able to cover the infrastructure gap in Africa.
But anything to add? Or?
Je dois ajouter qu'il faut.
So I would like to add that we also need the companies to, to join hands to get these PPP markets, because, we may have some subjects with different components, but when we are together, we are stronger and we can face it with more serenity. So the second point is training, capacity building. I think my previous speakers say that we need to train the people so that the government can foster this capacity building within the countries so that the companies, foster or encourage their officers to take part to this capacity building, because we have been founding a lot of projects in the region, but it is difficult to implement this project because the implementing staff is not trained. So within the companies, we may end up with the same situation. So we need to to have an emphasis on this particular topic. Another point I mentioned is the availability of the projects within the area. But for that, we need to set up a study fund, okay, within the WIMO, you know, because the BOD has made this exercise with seed fund, but that didn't succeed. So we might operate on this condition. So we need to put in place this kind of funds to allow the private sector to start some activities within these countries.
Break the ambience, but I have a few things to say. First, it's true that there is not a lot of default in Africa, but if there is $100+ billion missing in infrastructure investment, is because projects are not able to be mitigating the risks. And I still think that the biggest elephant in the room is the government, the volatility of regulation, and I will give examples. And I'm very interested also, en passant, by the soft infrastructure like hospital that can be replicated. This is a way to make a big change, because after, with the masses, it starts to be a game changer. But I'm the lead analyst for South Africa. So there is capital there is the local capital, there is the know-how, there are the company, and they are very sophisticated. And I've been visiting the country since 2009. And problem with the energy sector started a long time ago. We had discussions on what to do, and the government was very reluctant to break the monopoly of Eskom. And believe me, it has been extremely costly for the government. It was a drain on public finances. And I could repeat this discussion with other countries on the continent. To the point that everything was collapsing. And so now they decide in 1 year to remove all the regulation for private investment in the sector. And you have a record of projects, household, malls, REITs, mining sector. Everybody is in renewable. Big money, big time, very efficient. This capacity was there all along. It was not allowed to be deployed. That's it. And I think this example really illustrate the point I was making on, and to answer your question, what is the main issue I think that should really be supported is institutional strength and governance. This is really preventing more investment on the continent. You know, when you discuss with a government about the cost needs to be, the price needs to be cost reflective, and it's not understood, how can you foster investment in the sector? It doesn't work until it becomes too expensive, and then there is decisions that are taken. And we can multiply the example on that front. So the point really where I want to insist is that you have these two elements that are important, because governance also kills a lot of projects that compete with existing vested interests. But there is one as well that I want to stress, is commitment to the private sector growing in a sector from the government. You have a big example in Côte d'Ivoire. They privatized the energy and sector, the electricity sector, in 91. His Excellency President Ouattara was the Prime Minister, and they never went back on it. The CITEL and the CIPREL and the Azito that developed over time. Now you have most of the electricity is private sector, prior at least the dam. Because there was this commitment in this country that they needed to create the condition for private sector to fund the infrastructure in the electricity. And it's a success. Not many countries have been able to attract as much of private sector project, given its size, of course, relative to its size. So I still abide by what I said at the beginning.
Yeah, thank you so much. And very good interaction across. Thank you to all the fellow panelists. I think what we are hearing is that we need to get the virtuous cycle going, where the government needs to have the commitment, they need to have the capacity, they need to have the will, and then the regulations need to be in place which allow private sector investors, such as yourself, to start to invest. Once we have all these things going with project preparation, financing will follow. And with that, hopefully, we'll have many more examples of what you mentioned about what you're seeing in South Africa, what we are seeing in Cote d'Ivoire to follow across the continent. Please join me in offering a big round of applause for the panel members. Thank you.